Hello guys, today we will proceed to discuss another type of taxpayer, which are corporations. For the outline, this will be very similar to how we discuss income tax for individuals. First, we will define corporations, and then we will discuss the different types of income tax, which are passive income, subject to final withholding taxes, capital gains tax, and then RSIT, MSIT, and GIT. That's regular corporate income tax, minimum corporate income tax, and gross income tax. And then we will discuss different types of special corporations and the tax rates applicable to them. And we will discuss also a different type of tax imposed on certain corporations, which is IAET, or improperly accumulated earnings tax. And lastly, I will flash some administrative and filing rules. Again, the NIRC defines corporations by enumeration. So corporations are joint stock companies, partnerships, insurance companies, associations, and joint accounts. The difference between joint accounts and joint stock companies is that joint stock companies are a group of individuals forming another entity under an artificial name, while joint accounts is when one contributes capital to another without any formalities. So again, GPPs and exempt JVs undertaking construction projects or energy operations with the government and are accredited by the PCAB are not included as definition of corporation. For individuals, we have 5 different types of taxpayers, but for corporations, we only have 3. These are domestic corporations, resident foreign, and non-resident foreign. So these are taxed from their income within and without, while for RFC and NRFC, they are taxed from their income within. Let's proceed to the first type of income, which is passive income subject to final tax. So this is also very similar to tax on individuals. It's just that they may have some differences in the rates. This table shows us a summary of the final withholding taxes on passive income earned by corporations. So the first row pertains to different types of passive income, and the second row are some general rules that might be helpful to remember. So for interest on CBDs, deposit substitutes, and trust funds, they are not subject to they're not subject to exemption even if long term. So if you remember the discussion for individuals, some individuals may be exempt from their interest income if they meet certain qualifications. But for corporations, this is not applicable. Interest on depository bank under EFCTS, only residents are subjected to this tax. So this also applies to individuals, so only resident citizens, resident aliens, domestic corporations, and resident foreign corporations are subject to this type of tax. So the rest of our taxpayers are exempt. Let me also note here that the rate for resident foreign corporations remain at 7.5% because this has not been amended under train law. For royalties, corporations are not subject to the 10% tax even if the royalties pertain to books, musical compositions, and literary works. So this applies only to individuals. For dividends, I put here different type of transactions involving corporations. So if it's from a domestic corporation given to another domestic corporation, it is exempt. If it is received by a domestic corporation and this is from an RFC or an NRFC, we apply the rules on situs of dividend. And then for RFC, if received from domestic, again, it is exempt. If from RFC or NRFC, we apply the rules on situs of dividend. But if it's received by an NRFC, we apply either 15% or 30%. 15% is if we have reciprocity, and this is assumed if silent. So in general, we will use 15%. if the dividend income is received by a non-resident foreign corporation. And for prizes and winnings, this is not subject to final income tax but rather regular income tax in the case of corporations. This example is to illustrate the different rules on dividend income. So Lenovo Incorporated is a domestic corporation receiving the following dividend income for 2019. We have income from Microsoft and NRFC, from Intel and RFC, and from Panday at DC. It's also given here the ratio of gross income within for the past 3 years for each company. The question is, what is the total income tax for 2019? Again, the first thing you want to do here is label each income and determine the appropriate treatment. So income from Microsoft is wholly without, but since Lenovo is a domestic corporation, income from within and without are both taxable, so are RCIT. Income from Intel is partly within, partly without, but same treatment for the first one, subject to RCIT because dividends are from a foreign source. Lastly, DC to DC dividend is exempt. So the answer for the first question is 270,000, which is 500 plus 400,000 times 30% RC. For the second question, we assume Lenovo is an RFC. Income from Microsoft is wholly without, so this will be exempt because RFCs are taxed only on their income within. Income from Intel is partly subject to RCIT and partly exempt. Lastly, income from Panday is still exempt. So the correct answer for the second question is 72,000, which is 400,000 from Intel times 60% income within times 30% RCIT. Lastly, suppose Lenovo is an NRFC, the dividend from Panday will be subject to 15% because again, we presume reciprocity. So the answer is 45,000, which is 300,000 times 15%. Next example, ABC Incorporated and DEF Incorporated formed a joint venture. They agreed to share profits and losses in the ratio 70-30. The results for 2019 are as follows. So we have here the different gross income and operating expenses for each entity. The question is, what is the total income tax for ABC Incorporated? This is simply getting the taxable income of ABC, which is 1 million. That's 3 million gross income less 2 million OPEX times 30% RCIT. You could go wrong here if you add ABC's 70% share in the net income of the joint venture because we should not include that since it is treated as an intercorporate dividend and therefore exempt from tax. Second question, if the JV is an exempt joint venture, what is the total income tax of ABC Incorporated? Now the difference here is that since the JV is now exempt, it is no longer considered a corporation and the net income to be distributed is not considered a dividend. So we include first ABC share, which is 5 million less 3 million. That's 2 million multiplied by 70% or ABC share equaling to 1.4 million. We add this to ABC's taxable income amounting to a total of 2.4 million and we multiply that to the 30% regular corporate income tax. So the income tax of ABC is 720,000. That's it for final income tax on passive income of corporations. We now proceed to capital gains tax, which is also very similar to what we discussed in income tax for individuals. This is a summary of important rules in capital gains tax. First, the sale of shares of stock of domestic corporations, which must be directly to the buyer and not through the local stock exchange, except if the public company did not meet the minimum public ownership required by PSP, and even if through the local stock exchange, but the buyers were already predetermined and therefore there was no really public involvement. The rate For domestic corporations, it's the same with individuals, which is at 15% of the net capital gains. However, for RFC and NRFC, the rates were not amended. 5% on the first 100,000 and 10% on the excess. For the sale of real property, again, we have these exceptions. And for sale to government, it is still subject to capital gains tax. If you remember, for individuals, they have the option to choose regular income tax or capital gains tax for sale to the government. But for corporations, they do not have this option and they will be taxed at the 6% CGT. As for RFCs and NRFCs, there actually aren't any provision in the tax code, but in the rare occasion that you encounter a problem about this, we consider the income subject to RCT. Here's an example to illustrate CGT. In 2018, Moonwest Incorporated sold shares of stock for $250,000 directly to a buyer. The shares, which were acquired 2015, costed $100,000 and were held as investment. First question, how much is the CGT due? Second question, how much CGT is due if Moonwest is a foreign corporation? How much CGT is due if the shares sold are foreign shares? And what type of tax is due if the sale was made through the local stock exchange? So these are just different scenarios. The first one pertains to normal CGT, so it's just 250,000 less 100,000 cost. So the net capital gains is 150,000 times 15% CGT rate. So the answer is 22,500. The second one, Moonwest is a foreign corporation, therefore we use the old rate, 100,000 times 5%, and the excess is 50,000 times 10%. The correct answer is 10,000. The third question, the shares sold are foreign shares, therefore the income is subject to normal tax and not CGT. So the answer is 0. And lastly, if the sale was made through the local stock exchange, we know by now that it will be subject to STT or stock transaction tax. We are done with final income tax and capital gains tax for corporations. So now we will discuss briefly RCT, MCT, and GIT. RCT is basically just 30% of the taxable income for domestic corporations and resident foreign corporations. But for NRFC, the tax base is the gross income. MCT is 2% and the base is gross income plus non-operating income not subject to final tax. So these are just other income that you would have otherwise included as part of the taxable income. Only DC and RFCs are subject to MCT except those subject to special rates. So special corporations are generally not subject to MCT, and the general rule is that if the corporation is subject to RCT, then they are also subject to MCT. We start comparing the two types of tax, the MCT and RCT, on the fourth taxable year immediately following commencement of business. A small hack here is that you just use the formula n plus 4, wherein n is the year the business started. For the purposes of MCT, cost of services may include salaries and employee benefits of personnel directly rendering the service, cost of facilities, depreciation, rental, and supplies, and in the case of banks, interest expense is also part of their direct costs. So, excess of MCT over RCT may be carried forward up to 3 immediately succeeding years and may be applied when RCT becomes due. Corporations subject to MCT may be relieved from such under these 3 circumstances: prolonged labor dispute, fortuitous events, and legitimate business reverses. 15% GIT is based on gross income, and this option is granted by the President upon the recommendation of the Secretary of Finance. Like the MCT, GIT is available only to DC and RFCs, but there are certain requirements, which are the following. You can just read through here, but the most important is the COGS over sales of not more than 55%. So that's one thing at least that you should remember. This is also irrevocable for 3 consecutive taxable years. Let's review MSIT a little bit. Winter Company is an RFC established in 1990 and had the following results for 2019. So each year we have gross income, allowable deductions, and taxable income. Compute for the income tax liability. So each year we compute first the MSIT and RSIT, and of course we just compare whichever is higher to know what is the tax due. We also compute for the excess each year so we could apply it later on when our SIT becomes due. For the first 3 years, MSIT is due, and by the fourth year and fifth year, our SIT becomes due. So the tax payable for the first 3 years are simply the MSIT, 100,000, 120,000, and 140,000. By the fourth year, the 9,000 due is our SIT, so we apply excess MSIT in the previous year, so the tax payable becomes 0. Same concept goes for the last year. Our receipt of 1.2 million is due, but we have remaining excess of 206,000. That is 90,000 plus 116,000. We cannot include anymore the excess in 2019 because it cannot be carried over for more than 3 years. So the answer or the tax payable for 2023 is 994,000. So we are done with the types of income tax. Let's proceed to corporations subject to special tax rates. We have different special corporations, but still we classify them as domestic, resident foreign, and non-resident foreign. First, our special domestic corporations. We have PEIs or proprietary educational institutions taxed at 10%, but only if the gross income from related sources is greater than gross income from unrelated ones. So if income from unrelated is greater, then the PEI will be subjected to 30% RSIT. Second, non-profit hospitals. Rules for PEIs also apply, so we have the same treatment for the first two. These items highlighted or in brown are rarely tackled and limited problems are available for this. So I will not also emphasize them here, but it's good to remember them for theory purposes. So for Ecozone Enterprises, I believe I've already discussed this as part of special topics. So either ITH or 5% GIT will apply for registered activities, while for unregistered activities, they will be taxed at 30% RC. 3% goes to national government and 2% to the local government under 5% GIT. Microfinance NGOs are taxed at 2% on their gross receipts. Petroleum services contractor and subcontractors are taxed at 8% final tax on their gross income. Lastly, foreign currency deposit units of local banks under the expanded foreign currency deposit system are generally exempt, but they will be taxed at 10% final tax on interest income if they transact with residents. So this is just an overview. Let's discuss the ones in black a little deeper in the next slides. Proprietary educational institutions, again, are generally taxed at an example on PEIs. North University is a proprietary educational institution with the following business results in 2019. So North has tuition fees, miscellaneous fees, interest on bank deposits, rent income, salaries expense, other OPEX, and quarterly income tax payments. Additional school building was built and finished on April 1, 2019 at a cost of 2 million pesos and depreciable life of 50 years. What is the income tax payable if North University chooses to claim the cost of construction as an outright expense? So first we have to classify the income if they are related or unrelated. So tuition fees, miscellaneous fees are obviously related, and we skip interest on bank deposits because this is subject to final withholding tax. Rent income is of course unrelated. It's very obvious here that gross income from related sources is greater than gross income from unrelated sources. Therefore, we use the 10% special tax rate for North University. So the answer will be 147,000, and we get that by adding the income together and then deducting salaries expense, other OPEX, and of course the 2 million pesos which North University claimed as an outright expense. So we multiply that by 10%, that is the tax due, then we less the quarterly income tax payments of 48,000. So 48,000, so we arrive um, at the income tax payable of 147,000. Another example for PEI, South University is a proprietary educational institution with the following business results in 2019. We have tuition fees, miscellaneous fees, dividend income from domestic corporation, dividend income from a resident foreign corporation, rent income net of withholding tax, OPEX, and quarterly income tax payments. What is the income tax payable for 2019? Again, we first have to determine the appropriate tax rate for South University by determining which income are related and which income are unrelated. So it's worth noting here that dividend from domestic corporation is ignored because this is an intercorporate dividend, therefore exempt. And for dividend income from resident foreign corporation, we tag this as unrelated because this type of income forms part of our taxable income since it's from a foreign source. So we include that as unrelated income. And then for the rent income net of withholding, um, the withholding for an income is 5%. So we first divide 5.7 million by 95% to get 6 million. So the gross income from unrelated sources here is greater than the gross income from related sources. Therefore, South University is not subject to the 10% tax rate, but to the 30% RC. So the answer is 1,227,500. The tax due is we just add all the receipts, deduct the expenses, and then the tax credit will be 300,000 withheld from the rent income and the 250,000 quarterly income tax payments. So for non-stock, non-profit hospitals, generally also tax at 10% on their taxable income. And as you can see here, we apply the same concepts we've learned from PEIs or proprietary educational institutions. The only difference is that non-stock, non-profit hospitals are not subject to a special rule on capital expenditures. So they have to depreciate the capital expenditures and they do not have a choice to expense them outright. West Hospital is a non-stock non-profit hospital with the following business results in 2019. We have income from hospital operations, OPEX excluding depreciation for new building, rent income net of withholding again, dividend income from domestic corporation. Additional hospital building was built and finished on June 30, 2019 at a cost of 4 million and depreciable for 25 years. What is the income tax payable if West Hospital chooses to claim the cost of construction as an outright expense? Just like in the previous examples, we first determine what's income related to the operations and unrelated income. So for the rent income, unrelated is really 200,000 because this is already net of the 5% withholding tax. So we see here that the gross income from related is still bigger than gross income from unrelated income. Therefore, we use the 10% special tax rate for non-stock non-profit hospitals. The answer will be 152,000. That's 2 million less 500 OPEX plus 200,000 rent income less 80,000 depreciation expense. So again, non-stock non-profit hospital is similar to PEIs except for the fact that it does not have an option to choose the cost of construction of buildings or other capital expenditures to be claimed as outright expense. So we less 80,000 as depreciation. The taxable income times 10%, we get the tax due, and then we less 10,000 withholding tax in the rent from the rent income. So we arrive at an answer of 152,000. Lastly, for special domestic corporations are FCDU of local banks under EFCDS. So again, the rule is that they're generally exempt if they transact with non-residents, OBUs, or offshore banking units and banks. But if they transact with residents under other than OBUs and banks, then they will be subject to 10% final withholding tax. So this means that resident OBUs and resident banks are still exempt. To illustrate better, here's an example of the FCD of local banks under EFCDS. So a depository bank under EFCDS has the following income from foreign currency transactions, and $1 equals 45 pesos. So from non-residents, $5,000, from residents, $3,000, and from Philippine National Bank, $2,000. How much is the final withholding tax applicable? So for non-residents, this is exempt. From residents, this is subject to final income tax of 10%, and since PNB is a bank, this is also exempt. So the answer will be $3,000 times 45 pesos times the 10% tax. The answer is 13,500. This is actually another type of domestic corporations, GOCCs, and I just like to emphasize that generally they're taxable, but we have four exempt GOCCs. So these are GSIS, SSS, PhilHealth, and local water districts. We also have special resident foreign corporations. First are international carriers taxed at 2.5% on gross Philippine billings. Next are OBUs or offshore banking units. We apply the same rule we've learned from FCDUs of local banks under EFCTS. So for RAHQ, they are exempt, and ROHQ, 10% tax and subject also to 15% branch profit remittance tax. So the difference between um, regional or area headquarters and regional operating headquarters, RAHQ performs only the following functions: supervising, coordinating, and communicating functions only. The branch profit remittance tax is 15% of profit earmarked to be remitted, which is also the amount approved by BSP for remittance. So again, the items in brown are will not be emphasized in this discussion, but they're good to know for theory purposes. International carriers are taxed at 2.5% of gross Philippine billings on their carriage of persons, excess baggage, cargo, or mail originating from the Philippines in a continuous and uninterrupted flight, irrespective of place of sale, issue or payment of ticket or document. So these are the qualifications so that the receipts will be considered as gross Philippine billings. Note, if the subject alights in any Philippine port, stays for more than 48 hours, and thereafter boards with the same airline, this is still considered as originating from the Philippines. So the scenario here is that an aircraft which is originally set bound for another destination and makes a stopover in any Philippine port and stays there for more than 48 hours and then leaves again towards its original destination, then that flight will be considered as originating from the Philippines, and therefore it will be subject to gross Philippine billings, except if failure to depart is due to force majeure and with the same airline. Meaning, if there has been force majeure and the subjects board with another airline, the flight will be considered originating from the Philippines. So, for example, if there are any emergencies or disaster that caused the aircraft to land in the Philippine port, we will give consideration and therefore it will not be considered originating from the Philippines. But the the subjects which are inside the aircraft should be boarded within the same airline for it to be exempted. Otherwise, if the passengers or cargo or mail will be boarded in another airline, then the flight will be considered originating from the Philippines, regardless if it's due to force majeure. Second bullet, if there had been transshipment of subjects outside Philippines, it will still be considered an uninterrupted flight if the same carrier If subjects had been boarded on a different carrier, only the aliquot portion will form part of GPB. So for example, an aircraft from the Philippines is bound for another country, but it first makes a stopover, and the passengers or the subjects are transferred to another carrier of a different airline, then it will be considered an interrupted flight. It's not considered as interrupted, and therefore only the billings from Philippines to the stopover will form part of the gross Philippine billings. And last point, other income shall be subject to regular tax. Here's a good example to illustrate the concept on international carriers. Air Malaysia had the following gross receipts for transport of passengers in 2019. The problem goes to enumerate different types of flights during 2019. And the question is, what is the gross Philippine billings tax due and gross income subject to RCET? So each line item we will classify, or we will determine the appropriate treatment for each. So Manila to LA, tickets sold in LA. First, Manila to LA is a flight originating from the Philippines. And we know that for GPB, we don't take into account where the ticket or the document is sold. So therefore, the first item is subject to 2.5% tax. Moscow to Manila is definitely not a flight originating from the Philippines, and since the ticket sold in Beijing, this is not subject to RCEP. For the next one, Manila to Berlin, tickets sold in Paris, same case as the first item. Next, Manila to Dubai, stopover was made in Delhi, where passengers were transferred to another airline after 24 hours. So this is the example for transshipment of passengers. So Manila to Dubai flight made a stopover in Delhi, and the passengers were transferred to another airline. So this becomes an interrupted flight. So we only get the aliquot portion, that's 2.4 million times 2.5 hours over 6 hours. So that's the total hours of the flight. So the 2.5 over 6 is the aliquot portion, and that part will be subject to GPB. Manila to Toronto, stopover was made in Madrid, where passengers were transferred to the same airline after 24 hours. So here, a stopover was made, however, the passengers were boarded in the same airline. So this is not an interrupted flight. This is a continuous flight. So the whole will be subject to GPB, or the 2.5% tax. Next, Manila to Georgia, stopover was made in Bangkok, where passengers were transferred to the same airline after 6 hours. At first glance, what will occur to you is that they are transferred to the same airline. However, this is already after 60 hours. So this is no longer a continuous flight. Therefore, only the 3/14 or the Manila to Bangkok hours will be considered as part of gross Philippine billings. Next, Manila to Athens, stopover at Istanbul due to a typhoon. So even though there was a stop, it was due to a fortuitous event. Therefore, this is considered still as continuous flight. And then Chicago to Rome, tickets sold in Cebu. This is definitely not a flight originating from the Philippines. However, since the tickets are sold in Cebu, this will be subject to RCEP. And the cost of sale is of course related to that. And gross receipts from rentals is subject to RCEP as well. So here are the computations if you just follow the labels in the previous slide. So what's subject to JPB is 1.5 million plus 2.4 million plus the aliquot part of 2.4 million, which is 2.5 over 6, plus 3.6 million, plus the aliquot part on the 7 million, which is 3 over 14, plus 10 million, totaling to 21 million times the rate of 2.5%. The answer is 525,000. And what's subject to RCET is just the tickets sold in Cebu and the cost relating to that. So that's 3 million minus 2 million plus other income. So that's 7.5 million. For offshore banking units, again, this is the same as FCD of local banks under EFCTS. So transactions with non-residents, OBUs, and banks are exempt, but transactions with residents other than OBUs and banks will be subject to 10% final tax. Regional or area headquarters or RAHQs of multinational corporations. Sometimes they are termed as RHQ without the A. They do not derive income in the Philippines. They are tax exempt, but they may be constituted as withholding agents of the government. So again, they only perform supervision, coordination, and communication functions. Regional operating headquarters of MNCs or ROHQs are taxed at 10% of taxable income. So on the other hand, these are operating and earning income here in the Philippines, and the income derived by them when remitted to the parent company shall be subject to the 15% branch profit remittance tax. So the tax base is the total profit earmarked for remittance. Profits include only those connected with the conduct of trade or business. Therefore, passive income are not subject to BPRT. And activities registered with PEZA, SBMA, and CDA are also exempt from BPRT. Example for BPRT, Angkas Corporation is an RFC with branches worldwide, including the Philippines. Its branch in the Philippines had an income of 10 million in 2019. It earmarked 8 million for remittance, but actually remitted only 7 million. How much is the BPRT due? Again, the basis of BPRT is the amount earmarked for remittance. So the answer will be 1.2 million. That's 8 million times 15%. Lastly, for special corporations or non-resident foreign corporations. So cinematographic film owner, lessor, and distributor are taxed at 25% on their gross income, ships 4.5% on gross rentals, and aircrafts 7.5% on their gross rentals. Here's an example for NRFCs. Mimi Corporation, a non-resident foreign corporation, had the following income for 2019. So the bottom line is compute for the applicable income taxes. First, interest income with BPI Manila. This is of course subject to 30% final tax because this is a non-resident foreign corporation. Interest income from EFCDS is exempt because that's taxable only for residents. Receipts from rental of cinematographic works, as we have discussed, this is subject to 25% rate. Receipts from rentals of vessels, subject to 4.5% rate. Receipts from rental of office space, again, 30% final tax. Gross income from sale of equipment in the Philippines. No, this is not subject to CGT, but this is subject to 30% final tax as well. Net capital gains on shares of ABC Corporation sold directly to the buyer, and ABC is a domestic corporation. So this is subject to CGT, and we apply 5% on the first 100,000 and 10% on the excess. So if you just follow that, you will get a total of 1,136,000. Our last lesson before we proceed with administrative rules and filing is the improperly accumulated earnings tax, a special type of tax only for certain corporations. It applies to domestic corporations only that are considered closely held corporations. So these are corporations, 50% of which is held by 20 individuals or less. But exempt from IAET are banks and non-bank financial intermediaries, insurance companies, publicly held corporations, taxable partnerships, ecozone enterprises, non-taxable JVs, and GPPs. So my acronym for this is BIPTENG. So I know that you all know this very well already, so let me just breeze through the pro forma computation for IAET. So we start with taxable income, and then we add all other income that was not included in the taxable income. So those are the exempt income and income subject to final tax and capital gains tax. We also add back NOLCO. From that, we less income tax due and not just the payable. We less the final taxes and capital gains tax and the dividends that the corporation has paid. From that, we add the retained earnings beginning, and then we get the retained earnings end. From that, we deduct the amounts reserved for reasonable needs of the business. So the reasonable needs reasonable needs of the business is based on immediacy test. These are definite corporate expansions, future acquisition of PPE in compliance with loan covenant required by law, such as for treasury shares, and the 100% paid up capital. After that, we already get the IATI, or improperly accumulated taxable income. Then we just multiply the 10% tax rate to get the IAT. That's about it for income tax for corporations. So here are very common administrative rules and filing. So I'm just gonna discuss some deadlines and forms. Here are some important dates or deadlines and some important forms to remember. However, I would like to make emphasis on final withholding taxes on capital gains tax. So both for sale of real property and sale of share of stocks of domestic corporations, both are due within 30 days after the transaction. And then for the last table, these are income tax returns for different types of corporations. So 1702X is for exempt corporations with no other taxable income. 1702MX are for mixed income earners subject to different tax rates. 1702RT are for corporations subject to RIT of 30% only. And then 1702 is for the quarterly ITR, and 1704 is for the IAT return. So generally, for the annual ITR, the deadline is 15th day of the fourth month following the close of the taxpayer's taxable year. So since corporations, I think this is just the equivalent of April 15, but we note that corporations can use fiscal year. So, but I think they're equivalents. That's 105 days after the close of the taxable year. So for the quarterly, 60 days following the close of each first 3 quarters. And for the IAT return, 15 days from close of taxable year following the year when IAT was accumulated. So it takes more than 1 year for the IAT return to be filed, because when a corporation has improperly accumulated earnings, they have 1 year to declare the dividend so that no IAT may be assessed. So after that 1 year, IAT return is due within 15 days. That's it, guys. We're done with income tax for corporations. Those are the most important things you have to remember. What I want you to do is to practice and expect some exercises from me, maybe during the week or during the weekend. So good luck, and I hope that you learned a lot.